All right, good morning, everybody. Something to notice at the close yesterday was the buy side MOC. Now, this isn't the one that you would see on Finance Juice every day, right? When they start announcing the MOC in the last 10 minutes of the day. This is an MOC from a website called Market Chameleon, and they're using a filter. They're only looking for MOCs greater than 50,000 shares. I look at it every day. I've got a spreadsheet where every day we come in and we get this information, we put it in the spreadsheet, and I can go back and search that spreadsheet and see, what name has had MOCs going into the close greater than 50,000, going all the way back to 2020. I think we started doing it in September of 2020. So I look at this every day, and over the last week, we've been kind of riding in low numbers, which makes sense because, FOMC, right? So we weren't really expecting any significant shift in funds and holdings and anything like that. And the numbers kind of reflect that with a buy and a sell side, less than 200. That goes back from January 25, 26, 27, the 30th. And then there was yesterday, buy side 465 and the sell side 129. It's worth pointing it out. There was some pretty big numbers that came in yesterday. So interesting that it was right before FOMC, and there's always this dread or fear or maybe just a little angst that something would leak. Right? Well, I mean, there's not much to leak at this point. The Fed funds anticipated rate hike shows 25 basis points. And what we're all going to be watching for today is not whether they raise 25 basis points, because that's basically a given. What we're going to be listening for is, when is the pause coming? What's their target rate? So far, they keep saying the target rate is above 5. Well, we're not there yet. We're not going to be there yet for a while. It looks like maybe the fourth quarter of 2023 would be when we get into that target rate. And at that point, we're not expecting a pivot. We're expecting a pause. The market is expecting a pivot. But the Fed has made it pretty clear that they're not going to reduce rates. They're only going to quit raising them when we hit that mythical unicorn of the target rate. We'll see. Kind of a busy day today. With that aside, we do have the EIA petroleum status report at 10:30. It's definitely worth keeping your eye on. Now, on a day like this, when we're going to be anticipating a whole lot of lowered volume, so big price swings in different directions, because price moves easier when there's low volume. With that on the table, we could see, some pretty wild fluctuations through the day, testing the edges. On a day like this, the megaphone pattern really shines. It's what comes to mind immediately. If you were to look up the strat, he talks about that megaphone pattern a lot. And a day like this would make perfect sense. We're expecting a range-bound market, and even though it's ranged, we expect to overshoot that range on the high side and the low side, thus creating that megaphone pattern. And then we get FOMC. At 2 o'clock, the report will be released, and the algos will trade that. And then at 2:30, Powell will come out and chip his teeth. Sometimes he has an agenda, like Operation Don't Rock the Boat. It's where he would come out and just say a bunch of things that contradict each other and give the market no real clear guidance while he tries to avoid being pinned down with any serious questions and he leaves the stage. Not really expecting that today. So that's one path that he sometimes takes. The other path is when he comes in with an agenda, like say trying to knock the market down a little bit. If it starts to run a little too wild, we've seen him do that, say in Jackson Hole when he did that mic drop moment. He was supposed to speak for 30 minutes. He spoke for 8 and told the market to basically suck it up and take it like a big boy because it's going to get rowdy out there. And down the market went. Whew, it was nasty. Violent market drop. We don't really see that on the table today either because, we're not in this runaway market situation like we were back during the Jackson Hole situation. And yet what we do need from him, he can't really give without putting this market into liftoff mode. They are going to have to pause at some point. And as soon as they say they're going to pause, the market is going to explode higher. And so that is what you really need to be cautious of today and into the rest of the week, is that we could get a very large move to the upside. It might not stick, by Monday, we could wipe it all off the table and be right back down to where we are today. But in the next few days, the market could take his initial position as overly dovish, and we see that move upwards. So I guess the takeaway is be very careful today with your position and your portfolio. There's no reason to make big decisions about what you're holding or what you want to hold by the end of today. Also keep in mind that we have another FOMC in March, back-to-back FOMC meetings. So we have ADB this morning. We're going to get some manufacturing numbers. So it should be a pretty good day, all things considered. Looks like energy put in a bottom, crude and Brent, trying to turn around a little bit. So I say bottom, but it's that lower trend line that we were talking about, finding some support on that lower trend line. Didn't actually get there. But right now we're looking for some answers. The idea was to take a look at the really big red candle from January 30. And if this move to the downside was going to continue, we wouldn't come back up above 50% of that candle. And instead, we got this really beautiful long tail recovery, and we closed really nice in the upper portion of that candle. And now we're getting our continuation this morning. This is a classic trade opportunity right there. So if you haven't played that one before, kind of take a look at it. It needs to be on a pullback or on the low of a range. You don't want to try to trade that, say, up at the highs, because it doesn't quite work that good, right? Not at the highs. Asia closed inside the range. Europe is still open and testing against, well, it was testing against the open earlier of the previous day. Look at all those wicks across the bottom there in the European market. So a lot of buying pressure, and yet it just comes right back up into that 77.80 area with no real follow through yet, but certainly a lot of defense along those lows. And we're expanding relatively well this morning in the pre-market, considering how much Europe has moved in their open session today. It's 1240 in Europe. And they've got basically nothing. So we've got a pretty good expansion going on so far. Which really, when we come in and take a look at it, not too impressive yet. All right, so we got a very narrow IB. The IB is the initial balance between 6 and 7 last night. And then from that, we've already started to fade out, setting these lower lows. We've yet to challenge the highs of yesterday. And I think if we do, it will be a test and a fail, or maybe overshoot it a little bit and then fail. We really don't have an expectation that we're going to expand beyond yesterday's high until the FOMC report. So through the morning today, the expectation is to stay range bound for the most part and maybe overshoot a little bit. It's hard to believe that they're going to run this up into the afternoon. We've seen that before. We've also seen it go down through an afternoon waiting for an FOMC report. But for the most part, we've got a range set, our Globex low and the high of yesterday. And that's really our expectation. From that, the strat would come in, right? And that would be where the megaphone pattern would start to be anticipated. So it'd be this idea that maybe we wick a little farther through, and then we wick a little bit lower, and we wick a little bit higher, and we wick a little bit lower, and it creates this shape like that. Meta is on deck for earnings today. Something to kind of keep in mind. I was reading through some analyst reports, and its valuations are looking good, but I mean, it's still got the same issues that Facebook has been carrying forever. So I don't know. I think it might be worth looking at some YOLO plays in there, maybe putting on some cheap lottery tickets. Facebook has made some really big moves on earnings before, and that's kind of the only play, as far as I'm concerned, worth taking on earnings is, just a coin toss for a crazy explosive move way beyond its anticipated measured move. As for, trading it over the long term or even for a swing trade, I would want it to report first and then make a decision. It's on the Seeking Alpha contrarian list. So Meta and Netflix both are expected to be bullish through the year. And so far, that's been fairly accurate. All right, when we're at the bottom of this box, we expect to go to the top. When we're at the top, we expect to go to the bottom. This is a 10-day, 30-minute volume profile with a TPO on the right side. The point of control is in red at 40.35. We're going to lose this Wednesday's volume here on the back side as we progress through the day today. And unless we break out of the top of this thing, the expectation is that by tomorrow, this volume profile will be much more narrow than it is now, right? Because we will have lost Wednesday and we'll start losing Thursday. So we'll end up with a volume profile, unless we go down and revisit that area, of around this size here, 3960 up to 4100. Of course, today we have the expectation of a fairly large move. We could easily get back to 3900. We hit that VPOC yesterday going into the close or very near to the close. So we're done with that one. It didn't last long. And we hit the VPOC that we carried forward from Monday. So we still have another one, 42.30, and we have one underneath this, 39.88. You just see the size of this volume profile this morning. It really kind of drives home how narrow our range has been in the overnight. And, it really looks like we're testing a breakout this morning, which we do have enough econ coming in to get that breakout. And I don't know, maybe it's worth gaming it out. It's kind of hard to see how anybody would, play the econ that we've got this morning, knowing that we have FOMC this afternoon. But just because I don't think it's a high probability thing doesn't mean we shouldn't game it out. The market maker move is 0.75%. And our ADR is 1.5%. So that gives us a 2.25% anticipated move. And like we've discussed before, if you go back last year and look at big move days, they were usually round numbers, 2%, 2.5%, 3%, 2.25%, 2.75% doesn't really fit. So if we're going to measure out and add this additional market maker move, it might be worth doing that, and then just taking it up another notch and going to 2.5 instead of 2.25. This yellow line here is the full ADR, so this is 1.56. It's a good place to start. So from 41.49, we'll just add 0.75%. And that gets us right above the September high. You're looking at 41.80, basically, right around in there. I would focus on the September high as my line in the sand with a potential overshoot, right? We could drift through a little bit. So we'll just add the label to that market maker move percent. Take things in the other direction. $39.91 for the downside. All right. This is our range for the day. When we get the FOMC, we could move anywhere through this zone and actually hit both edges of the zone. Something worth mentioning, which it doesn't really happen very often, but that doesn't mean it can't happen, is the idea that we don't necessarily have to see a big move today. It doesn't owe us a big move. If Powell comes out and threads the needle in such a way as to not really give much clarity or guidance on where they're going to go next in March, while at the same time they hold their 25 basis point anticipated rate hike, and he doesn't manage to chew his foot, right? We could just kind of dribble around between the regular ADR and kind of close where we are within this zone. So just kind of, keep it front and center in your mind that it doesn't owe us a big move. We're anticipating a big move. because at this point, the Fed is kind of trapped. And how they get out of this trap is what we're all kind of focused on. Right after the close, we'll have Meta. Through today, it's very likely that these FANG names and the monsters of tech and these big mega market cap tech names are not likely to move around too much. In fact, most of the market is expected to not really move around that much. But again, when you have a lower volume environment, it doesn't take very much to make a market move. So we could see some wild movement. It's just not expected, right? Right now, Meta has a market maker move of nearly 10%, and it has an average daily range of 2.75%. So you can see how big the market maker move is compared to what an average normal daily move in Meta would be. I hate calling it Meta. It's Facebook, darn it. So we're looking at nearly a $19 move between these two. If we round up for some easy math and we say that we're sitting at 150, then we add $19 to that, we'll be at 169. Really close to that 170 mark. So we're looking at a gap fill if we were to go up. Of that gap fill right there. That's a potential gap fill. And to the downside, it would be right around this 130 area. Which would be the old gap that did get filled. Sorry for the pause there. I had to choke back a giggle. Seen this, the name of that line, and couldn't help but think of a really good joke, but it's not the time or the place. Wednesdays, need more coffee. So that's kind of my range for Meta today. It doesn't necessarily line up with the implied volatility average here, which is 15.5, that we would also add the Meta market maker move to, and that would be a $30 range rather than that $28, $29 range. But it's how close it is, right? The average daily range that we're using is a 21-day, 21 bar average, and it ties in really nice with this implied volatility average that we've got here. They're really close together. So it's just conformity, right? I like how it all came together, even though we approached it from different directions. So that's the range today for the earnings. And of course, if you're going to play an earnings trade specifically for the earnings, you want to try to get in later in the day, as close to the announcement as you can. So you wouldn't want to get in this morning in Meta. You want to wait until this afternoon, especially under the idea that when Powell comes out chipping his teeth, he could make Meta move, a good 3%, and then it closes and it could move from there, another 12%. So if you were to get in this morning, you could be more than 20% away, from its destination and be that far off. So just wait as we get closer to the close. I think the way that I'm looking to play this is probably something like a butterfly at the gap fill, something right up around that 120 area with a butterfly, kind of try to widen it out. And the same thing for the old gap, a butterfly around 130. So those are really, really cheap things. And since it's going to win or lose with no middle ground, there's no way to save it or salvage it or fix it. No management of that trade other than to close it. You want to keep them small. All right. When you go to the gas station and you buy a lottery ticket, you don't go in looking for $100 lottery tickets, because your chance of winning the lottery is a snowball's chance in hell. So you go in and you buy a couple of the cheap ones. Same thing here. Don't make this thing some big, massive butterfly thinking that if you just make it big enough, it's bound to win, because that's not true. And both of these butterflies could lose. It's not a guarantee that, you're going to hit one side or the other. You could miss both sides. And we're spending the time looking at this because there's really no reason to go out and dig around on what's moving this morning in the pre-market, because there's really no opportunity to do anything until the Fed talks, right? Anything else would just be more risk than it's worth. All right, a $30 butterfly. It's $5 wide. 10 if you take it from break even to break even. This covers 175 all the way down to 165. It's a $10 box, and that's not bad. I mean, it's $30. If you're wrong and Facebook does not go to the upside, you're going to lose your $30. There's no negotiating on that. All right, so those two red lines would be the size of the butterfly. If price gets anywhere in that box, there would be some form of profit if we can hold that going into Friday. The thing about a butterfly is it doesn't just have to get there once. It has to get there as it gets closer to expiration. All right, so here's another one, also $10 wide, going from 125 to 135. It's around the same cost, around $30. And that would be the zone that we would be looking for Meta to hit. Now that we have those two locations, we've got these boxes. If you didn't want to do the butterfly, which I get it, the anticipation that it's going to be in that location on Friday rather than getting there, from the report or even on Thursday morning after having had the report, it kind of makes the idea of putting on the butterfly maybe a not so hot idea. But rather than doing the butterfly, we could also do something just as simple and say, do a debit spread. It's still near the same cost. You could kind of overshoot it a little bit if you wanted to. Since we're discussing a fast move in a short time frame, if you're going to do the debit spread, there's really no reason to use the February 3s. Now, let's just finish off there at the February 3s. So if you're going to do the February 3 and you don't want to do the butterfly, don't do the spread. Look at the cost of this thing is $23. You could just spend $20 and buy the 190 call. Now, I don't think Meta's going to 190, even if they had a good earnings. We've already talked about 170 being the measured move. But if you have the 190 and price makes a fast, hard move in the right direction, this 190 call is going to monetize. How much? Well, we can see just from using strike price shift differential that if price moved $20, this 20-cent option would be worth around $1.20 or $1.30. So you would make $100, $120 just in that short span of time from that quick move in one direction. And this isn't taking into account volatility or anything else. It's just strike price shift differential. What would it be worth if Meta moved $20 today? It'd be worth about $1.30. Okay, I mean that's not bad. No reason to do the spread. If you wanted to do the spread and to play this earnings move and still have perhaps a little bit of time left to manage the trade if it doesn't work the way that you would want it to, February 17 looks pretty good. The open interest is okay. It's not bad. And the bid-ask spread is tolerable. Here's a $25 wide debit spread, risking $1. It can be managed, rolled, adjusted, converted. You can actually do something with this if things aren't working, and your max risk is $1. And since we're looking at a $25 wide call debit spread, this has the potential to make a lot more money, right? A lot more than that butterfly. So something to consider, right? If you don't want to make it this wide, if you make it less than this, the risk is less. So that's the upside. 180, 205, maybe 180, 200 if you like that number. For 10 cents more, I'd rather use that 205, but I can hear Tom Sosnoff, in my head saying, avoid the round numbers if you can. Avoid the option that is $1. Avoid the strikes that are on the round number. Maybe it doesn't matter, but when we can. All right, so for the other side, these puts aren't going to be so cheap, right? When we're looking for, yeah, he did this interview with Tony Zhang. Him and Tony are like old friends. They like interview each other back and forth and host each other on their shows. And they were just kind of chit-chatting and he had made a off the cuff comment about oh, I don't remember the phrase that he used. And Tony asked him to clarify that statement. And he said, well, yeah, you want to avoid the suckers bet. All the people who hate math and think math is stupid and they don't want to do math, they find options a little complex. They'll use that round number. They'll just gravitate to it. And you'll notice a dollar option, an option that is trading for $1 in cost, will usually have a higher open interest. It'll start getting a lot more volume when it's at that cost of $1. Strikes on the round number generally have more volume and more open interest, because it's easier for people to do the math on the round numbers. And his argument for avoiding it was that you usually find the costs are a little inappropriate. He said it's not fair value. If you remind me later after the stream, I'm pretty sure I know what interview it was, and I could send you the link. Tony Zhang runs the shoot. He's got his own little company, Options Play. He runs Options Play. All right, so there's some ideas, for Facebook. They're just really cheap YOLO ideas. And obviously, you don't have to make these things $1. You can make them small. There's no reason, to go big like I did. I like widening it out because it exposes the trade to more Greeks. But if you're looking at this and thinking, I don't want to play a lottery ticket at $87 a piece, yeah, sure, narrow it up a little bit. And you can make this thing as small as you want, right? Make it $1 wide, risk 20 cents. That's still a really great risk to reward. If price was to move in that direction fast, this would easily monetize for 100% of your debit. So you risked 20 to make 40. The max profit is 80. Try to split the difference in there. It's not that bad. What I would not recommend is an iron condor on Meta for earnings. That's a really bad idea. I know I've done videos in the past that talk about the earnings iron condor. And the idea is that, believe it or not, most companies that report earnings, they get a lot of violence in the first day or two, but then they just revert back to the mean, right? They come home again. And so if you put on an iron condor, statistically, you're going to win more than you lose, because most earnings aren't these breakaway runners that just keep on going, and statistics are on your side. We were looking at Spotify yesterday for some earnings plays, and this is a good example of a company that had earnings, dropped down, and then came right back up within 2 or 3 days. Had earnings, spiked up, and came right back down within a few days. So, it fits the bill, not perfectly. There's earnings where it made a big move and kept on going. But for the most part, sleepy, boring, no Joe Schmo companies that nobody's ever heard of, they'll just report earnings, get a little bit of violence, and really end up right back where they started. And those are really great iron condor targets. What you don't want to do iron condors on are things that are all over social media, all over the news, had a big gap last earnings, because then everybody's going to be trying to play that big gap again. This earnings brings in even more eyeballs, even more people. You don't want those to put an iron condor on. You want to avoid those with an iron and put on butterflies or skewed flies or verticals or something else, something. I was trying to remember the location of the trade we put on for earnings yesterday on Snap, and I couldn't remember. It was Feb 3, 15 and 18 for the call side, and 5 to 8.5 on the put side for Snap. That one we filled right before the close yesterday. We didn't get to 8.5, but we're working in the right direction. Those were debit spreads out of the money, running at about 16 to 18 cents a piece. Really cheap stuff. All right, so for nat gas, we're at that $9 level, and we had a nice recovery candle yesterday, but I'm going to stress caution. This red hollow candle is hollow because we opened it down here and we rallied up to close here, and then we gapped up and we closed even higher than that before falling all the way down and closing down here. Then gapped down and rallied back up. So if we're just looking at the last 2 days, we look at this and think, oh, wow, yeah, they gapped down and look how strong they rallied up. It looks great. Maybe we can get a continuation. I would really hold off on that. I wouldn't be trying to put on, put credit spreads or anything like that, thinking that this is bottomed out. Let it prove itself a little bit. Even back here, it spent 3 days kind of holding that $10 level before it dumped, massively dumped. Let this thing prove itself a little bit more. There's no rush. When this does finally start moving back to the upside, there's plenty of room. So there's absolutely no reason to, get in here early. Bitcoin down 1% this morning, not much of a surprise. The Bitcoin futures are huge, massive. And, you got to kind of have the expectation that people are going to want to reduce their risk coming into the FOMC. Communications, junk, construction. We got, a housing econ this morning. We got the JOLTS numbers at 10. That petroleum status report has the capacity to move the market in our current environment. So it's worth keeping your eye on the clock at 10:30. And then we have these additional auctions at 11. Just bear in mind, even though we have the 30-year today, which is a big one, and we have the 10-year today, which is a real big one, none of those trump the FOMC announcement. I meant to point this out earlier in the week that we had this trend line breakover on the weekly. You can kind of see it. So yellow dotted line headed to the downside. We had that breakover and we closed last week outside of that trend line breakover. It's the first time we've done that since we've made this descent or started the descent back in 2021, right into December, into January 2022, headed to the downside. This rally that ran us up and set that high was an FOMC rally. Then we had the June low into the October 200-day moving average rejection. Then the November, December rejection. So every one of those, you know, we set the trend here, set the trend line, tested and failed. We tested and failed. We made it through and we closed above it and we kept it so far. There was someone on stockcharts.com yesterday, and I think it was Daniel Steele. I don't want to say that 100%, but I think it was her. And she was calling for a bullish market into 2023 through the year. Now, she hasn't been the only one. There's been a number of stock chart analysts. If you watch, you know, like Stock Chart TV and you follow them on YouTube, there's been a number of those analysts who have been calling for this to rally back out. Not necessarily in all those big mega cap names, not the darlings that we would all normally focus on: Apple, Microsoft, Nvidia, you know, not that group, but everybody else, all the other names. It's worth, you know, kind of hearing what they have to say. And then JC Perez, who appears on stock charts from time to time, but kind of runs his own thing. He's also bullish the market. So something to consider if your focus is not on the big mega market cap names. A lot of the market is recovering and it's bullish and it's setting trends to the upside. It's just the indexes and the major market caps that are really struggling. Yep, Tom Bowley too. That's another one. I find him hard to listen to. He's so raspy that it's like, dude, drink some bourbon, you know, get some coffee or something. But he's sharp. I'm going to kind of wrap up with this. What we get today from the Fed very well may be muddy water, that they might not come out with very clear statements. And that would kind of be par for the course, right? That they're trapped and they might not have a really good way to frame the message yet. It's possible. And then after he's done speaking, they're going to find a way to clean the narrative up a little bit. And then that will be the drum that they beat all the way up into March. So don't take the end of today's price action as forward guidance on what we're going to do between now and the next FOMC. You're going to want to pay a lot more attention to reports that come out on Thursday and Friday, and really listen to what analysts have to say about what happens today. Listen to, you know, Tom Bowley and JC Perez and these other people that are out there that are going to really parse the words of what he says and give some clarity on what we're going to get going forward. We also need to keep our eye on the bond market, because the bond market very often leads the rest of the market when it comes to what they think the Fed is going to do. So they kind of set the narrative. The white lines that you see here are previous FOMC announcements, and then the takeaway from that, right? You can see like what happened with the market afterwards. And for the most part, if it was negative, it stayed negative. There's a couple of times like in October where it was negative for one day, and then, you know, we had that turnaround and had a nice rally off the October lows. But other than that, for the most part, what we got from FOMC stuck. Last year in March was one of the biggest FOMC rallies. The other one was in July. If this does turn bullish, the move could be seriously impressive. So bearish, I'm not looking for, you know, seriously massive moves, but bullish, yeah. Someone mentioned the dollar was dropping. Before I started streaming, I was keeping my eye on US dollar Japan, and it had started to make this move here. And we weren't really getting any follow through yet in the dollar. But now, after it went down even more, and we're seeing it, you know, reflected over here in US dollar China too, we're now starting to really see it. Notice the dollar's dumping, and the S&P and the NASDAQ are not popping higher. I was having this conversation with somebody yesterday. For most of 2022, we were all watching the dollar really close, nearly tick for tick. If the dollar went up, the S&P went down. If the dollar went down, the S&P went up, nearly tick for tick. But about halfway through December, maybe closer to the end of December, I wrote a post that talked about how this is going to decouple at some point, and that we're starting to see small reverberations of that. And that was back in December. It's getting worse. It's going to get to the point where we're going to see big moves in the dollar, and we're not going to see a reflective inverse move in the S&P and the NASDAQ, which is exactly what we're having right now. If a kind of move like this had happened, say in September of last year, the S&P would be spiking up to 4,100. And yet here we have the dollar dumping, and we got nothing, right? Nothing. So I'm not saying don't watch the dollar. I would never ignore a data point that I know has value or context, but don't automatically assume that dollar is going to give us something, and it's not. You know what I mean? Like, where's the follow through? So instead, what I've been doing with the dollar is setting levels or benchmarks. The dollar below 102 was my benchmark yesterday. I kept saying if this move in the dollar was to drop below 102 yesterday, we would very, very likely see a response in the S&P and the NASDAQ. And instead, we held that 102, at least into the close. And we never really did get that follow through for the next leg up in the ES and the NASDAQ. Now we're getting that move down this morning, and 101.5 is going to be the line in the sand that we want to focus on. As long as the dollar is still holding above 101.5, maybe even just 101.60, this pivot point back here from Monday. As long as we're maintaining within this range structure, it's hard to see the S&P getting up to 4,100. But if we break 101.5, and especially if we break it with conviction, and we see the follow through in US dollar Japan, US dollar China, then 4,100 is absolutely on the table. Getting through it and getting above it would be the focus and the target. Just keep in mind that really easy system that we were running where we had an inverse dollar and we could trade the S&P based on the movement of the dollar. Those days are done. It's gone. It was fun while it lasted, but it's not here anymore. And we have to adjust our approach, right? Those were good times. We had to get it while the getting was good. Absolutely. There is always something else. And hands down, one of the best things that you can use, one of the best indicators, tactics, strategies, anything. Open, high, low, close, and look at the clock. I haven't found anything better than that. Nothing. No, looking at the clock, there is economic reports that come out all day long. All day long. The ones that we see here in the calendar are only a fraction of them. But a lot of them are like these boring behind the scenes kind of like just boring stuff that and it just doesn't hit the news, but that doesn't mean it doesn't move the market. So rather than trying to hunt them all down and trying to figure out like which one is going to be important today or could it be important today, if you just watch the clock, it's going to happen on a half hour or on the hour. So we know that 30-minute time frames are critically important. Every hour on the hour, 5 minutes till, I start looking around and thinking about what kind of move we could see. Are we near a high? Are we near a low? Are we near a breakout point? Because if we're near a breakout point and the hour is just about to end, I'm going to game out a reversal like this 10 a.m. reversal we had down here or 10:30 reversal. It literally reversed on the dime on the clock, right? So open, high, low, close, and watch the clock every half hour. For me, that's easy. I'm a full-time trader. I'm at the desk all day and I've got my own little routine. So usually about 20 after, 25 after, I come in and I game it out and think, okay, are we near this high? And is it nearly 3 o'clock? Literally like we were this day. You know, we're near one of those 4 pivot points and it's 3 o'clock. If we're going to reverse, that would be where the reversal would be at. It doesn't mean I know it's going to reverse, just it has the potential there. Breakaways, rallies, reversals, a flip of the script where the market just suddenly changes direction and goes, or breaks a range and begins to go. It doesn't necessarily have to change direction. So by watching the clock, recognizing that those half-hour time frames is where the market has the potential to really change its dynamic structure, and then focusing on open, high, low, close, you're good to go, like just like that. And the 9:55 one is a big one for me, between 9:55 and 10:05. If we're going to break out, it has to happen within that time frame. A lot of times the market, even in a trend, if it breaks out at 9 a.m. and starts trending right away, it will pause at 9:55 to 10:05. A lot of times it just stops there, like it did right here. 9:55, we stopped. 10:05, we started going again. So the clock is a real big one for me. And I've had people ask where they could learn more about it. Where did I learn it? I had to put it all together by myself. I didn't find a book on it. I got pointed in the right direction by some books. And unfortunately, I didn't keep the name of those titles. I should have, so I could reference them, but break the day down into at least 2 time zones, your morning session and your afternoon session. That's a big one. It's been around forever. I didn't invent that. If you wanted to take it a step farther, break it into 3 zones. That way you have your morning zone, you have your lunch, and then you've got your afternoon zone. 2 is less complicated, right? You've got your morning and you've got your afternoon. And keep in mind that anything that happens in the afternoon is a completely different market than what happens in the morning. We could, completely shift directions and go from bearish to bullish or vice versa. Without the bias doesn't carry through. And then just play mahjong. And I've had people, reach out to me asking if I'm serious. I am serious. Mahjong is nothing more than matching pictures together. These days repeat again and again and again and again. So, randomly pick a day that you liked. This V bottom reversal, for an example, where we ran into the afternoon and had a midday breakout above the open. We've seen this day before. We absolutely will see it again. And we ran right up to where we had closed the day before. That was literally the target once we started turning and heading in that direction. And if you were to go back and look, you could find 50 different days where this has happened, and it looks exactly like this. Maybe not candle for candle, but it's the exact same move. And the sooner that you can recognize that today is a day that you've seen before, and you know what that day looks like, you know where we're going. You'll also know if things change. News could have broke this, and we could have just dumped. And we would have known that it was broke. We would have known because we had an idea, a very clear mental image of what it was supposed to do. It was supposed to go to here. So if it breaks and begins to fall, we'll know, uh-oh, hey, it broke the pattern. Something's wrong. And there's examples of those before too. You can find them. So range days, fake outs, reversals, all of these days, we've had them before. We will have them again. But this is for the indexes, not Facebook, Meta, Apple, Microsoft. In the indexes and in the sectors, these days repeat. And it's not even necessarily pattern recognition as much as daily recognition, although that is a pattern. I just haven't found a good way to articulate that yet. But the day itself, the shape of the day itself is a pattern. Everybody, be careful today. Prepare for the violence. And, I know people who take today off. They don't trade FOMC. When I was new to trading, that drove me crazy. I thought, why would you deliberately avoid such a day? But I mean, I get it now. It's going to be violent, and even up to the 2 o'clock time frame, we could see a lot of fake outs and reversals and just shenanigans. So maybe it's a good day to go bake some cookies and avoid the chaos. I'll see you guys tomorrow.